Welcome to Module 4. This is on Chapter 5 of Accounting 503, and this chapter is all about gains and losses, mostly capital gains and losses. So we're going to talk about the basics of gain-loss realization and recognition. This is a little bit of a repeat. We're going to talk about amount realized and adjusted basis. We're going to talk about capital assets. And then lastly, how capital gains and losses are taxed. Okay, so first we need to start with a little introduction to sales of property. So gross income includes gains, almost always gains, and sometimes losses from the sale of property. So recall our realization versus recognition standards. A realization event is that significant change in ownership rights. Typically, we think of that as being a sale, exchange, or disposition. And once we know that we have a realization event, we should be thinking amount realized minus adjusted basis, because that's going to throw off the realized gain or loss. And if that thing's not deferred or exempt, it's going to be recognized. So what is the amount realized? Simply put, that's what did you get. So did you get any cash? Did you get property? If so, included at its fair market value? Did anyone assume away some of your liabilities as a result of this? Then if so, that's part of your amount realized. And then minus any selling expenses. So it includes the fair market value of property. So under the tax rules, what is fair market value? This is the price at which property would change hands between a willing buyer and a willing seller, neither being under any compulsion to buy or sell. So it's not a coerced sale. And that's the price at which whatever that property is would change hands. In an exchange, the general presumption is that the fair market value of the two or more items exchanged is equal. So, for example, if Bill trades land to Susie for stock worth $30,000, let's assume that the stock has a readily determined value, right? So it's stock traded on an exchange, so we can determine what the value of that stock is. And generally speaking, you can just assume that the land has an equal fair market value, or else why would they be entering into that exchange? Now, there are situations, especially related party situations, where the property can be exchanged and it's not for equal fair market value, but that triggers maybe either part gift or part compensation or something like that. Okay, so the other part of our equation, amount realized minus adjusted basis. So adjusted basis, generally the cost, less any cost recovery that the taxpayer is allowed or is allowable. So that typically comes in the form of depreciation, amortization, and then something called depletion that has to do with natural resources, which we're not going to spend any time on. We'll talk more about basis shortly because, of course, it sometimes deviates from this general rule. So when we think about capitalizing the cost of something, right? So what we're trying to do is differentiate between what's it mean to deduct something and what does it mean to capitalize that cost? Because if I have deducted the cost, then I have no basis, right? The basis is zero because I've deducted the entire cost. So a deduction, we think of the entries as being debit to expense and credit to cash. And the deduction expense is recognized directly onto the income statement. And as a result, it has no real life. Versus capitalize, which would be debit asset and credit cash. In this case, the asset or property is recognized on the balance sheet because it has a life. And the cost of that asset may or may not be recoverable. And it might be recoverable in the near term, and it might not be recoverable until much later or until it's sold. So things that get capitalized are things like property, plant, and equipment, right? These fixed assets that we're used to seeing. Prepaid assets are capitalized and then amortized. Intangibles can be capitalized. And of course, the cost of inventory, strangely enough, is capitalized until that inventory is sold, and then it becomes cost of goods sold. So even that is a capitalized cost. So all these share the same characteristics. They land first on the balance sheet and then find their way to the income statement through a variety of methods. So, capitalize versus deduct. Section 162 says, there shall be allowed as a deduction all the ordinary and necessary expenses paid or incurred during the taxable year in carrying on any trade or business. And so that would certainly lead you to believe that anything ordinary and necessary that was paid and incurred during the year can be deducted. However, Code Section 263 comes along and says no deduction shall be allowed for any amount paid out for new buildings or for permanent improvements or betterments made to increase the value of any property or estate. So we have a little bit of conflicting evidence here, right? And so what's happened is there are a series of regulations that are under Code Section 162 and another set under 263A, or sorry, 263, well, inventory's under 263 Cap A, that help define the dividing line between these two choices. Those regulations are definitely beyond the scope of this course. Typically, the basis of purchased property is the original cost adjusted by certain installation-related items. So, for example, if you pay sales tax, freight charges, installation, and testing fees, I usually think of these or would classify these as the cost necessary to get that property ready for its intended use. So the basis of real property, therefore, will also include things like settlement charges. These are legal and recording fees, title insurance, etc. These are costs you incur to establish that you have clear title to that property. And generally in the U.S., in most states, that's required, right? So if you own property, you have to file a deed with the county. And so consider those as costs of getting that property ready for its intended use. If it's property you construct or build, something called the Uniform Capitalization rules apply. I generally think of that as being beyond the scope of this course, but it's similar to inventory. Okay, so let's talk about some problems and issues with basis, because basis is one of these boring items, right? It's what you pay for it, less any depreciation typically. So let's go through some of the areas where that doesn't always lend itself to the truth. And the first one we'll talk about is identifying the property. The second one is when it comes through a gift. The third is through inherited. And then lastly, when you convert personal property to business property. Okay, so identification relates to the sale of a portion of what I describe as non-distinguishable property. So think of it as all the property's the same and it's just in a big bucket and you're pulling some out and you're not really sure which one it is. So let's say you own 1,000 shares of Cheesecake Factory stock and you sell 100 shares. Which 100 shares are they? And the tax rules say you can use either the FIFO method or specific ID. So there are no other choices. You can't use LIFO, can't use weighted average. It's either FIFO or specific ID. So let's walk through some examples. Let's say you purchased 500 shares of cake in 2014, $25 a share. And then you purchased 300 shares in 2016 at $30 a share. And then lastly, you purchase another 200 shares in 2018 for $45 a share. And you sell 100 shares on December 31st of 2018 for $40 a share.
Let's start with the FIFO method, which includes the shares that were purchased in the oldest tranche back in 2014. So the amount realized is $4,000. That's the 100 shares times $40 a share. The adjusted basis is $25 a share times the same 100 shares sold, or $2,500. This results in a realized and recognized gain of $1,500. Because the shares were bought back in 2014, the character of the gain is a long-term capital gain, which means that the tax rate that would apply is 0, 15, or 20%. Let's next consider if we sold the shares that were purchased in 2016. Let's call that the mid-aged shares, for example. So the amount realized would be the same, be 100 shares times $40 a share.
$30 a share times the 100 shares, or $3,000. Now the realized and recognized gain is down to $1,000. It retains the long-term capital gain character, and the same rates apply. So you can see just by shifting which shares you're designating as the shares you've sold, you're actually changing the gain amount. In our last example, we're going to use specific ID, and we're going to use them out of the newest tranche of shares, those that were purchased in 2018 and then sold in 2018. So again, amount realized is the same, 40 times 100. This time the adjusted basis is $45 a share, and as a result, you've generated a realized and recognized loss of 500. The character of that loss would be short-term capital loss, and the tax rate that would apply to that is ordinary. Of course, this is subject to any netting rules that we will talk about later on in this video, and then even more so in class, because the netting process is fairly complex. So you can see that choosing different shares as the shares you sold really can affect your taxable income. So in this case, if you had maybe no other losses and you wanted to recognize some losses, you could take them right away. The alternative is if you wanted to capture some long-term capital gains, because maybe you had some other losses you wanted to offset, you could do that. So a little tax planning can go a long way. Before we leave this slide, it's important to let you guys know that you could pick 33 shares from the 2014, 33 shares from the 2016, and 34 shares from the 2018. There's no rule that says they all have to have come from the same tranche. As a matter of fact, you don't even have to pick them in equal numbers. You could pick one share from 2014 and all the rest from 2018. But you do need to do specific identification at the time of the sale. This is not something you can do post hoc, right? It has to be a concurrent election with contemporaneous evidence that you've selected those shares to sell. Typically what happens is you notify your broker, and your broker stamps that as specifically ID shares. Okay. So let's go on to our next weird example. And in this case, Stephen receives a watch worth $900 as a gift from his significant other. And the significant other originally bought the watch for $600. However, a short time later, she dumps him. And poor Stephen can't stand to even look at the watch another day and decides to sell it for $400. So we know his amount realized on this sale is $400. We have a realization event, so we ought to be thinking amount realized minus adjusted basis. The question is, what is the adjusted basis of property you receive as a gift? So that basis could be zero, right? Because that's what he paid for it. He has no real basis. He's made no investment in the watch. It could be 400. That's what it's worth when he sold it. Maybe you think it could be 600. That's what it cost the significant other originally when she bought it. Or maybe his basis should be 900 because that's what it was worth when he received it. So you can see the gift property leaves a door open about how we need to define adjusted basis in an event when you receive property by gift. So the tax rules say that gift property takes a dual basis. So what you do is you compare the fair market value of the property to its basis at the time of the gift. If the fair market value is greater than basis at the time of the gift, then the donor's basis simply carries over. If, on the other hand, the fair market value is less than the basis at the time of the gift, then it depends, the basis you would take depends on the sale price when you dispose of it. So if it's sold for more than the donor's basis, then the basis carries over. If it's sold for less than the fair market value, then the fair market value is basis. However, if it's in between, then the sales price is the basis. So let's do an example. So here we are. Stephen sells the watch, or gets a watch worth $900. That's the market value. Originally purchased for $6, sells for $4. So was the property appreciated or depreciated when it was gifted? Well, at the time of the gift, the market value was $900. The cost was $600, so it's clearly appreciated. As a result, Stephen takes the carryover basis, which is $600. That was his significant other's basis. When he sells it for $400, he has a $200 loss. However, because this is a personal item, it's a non-deductible personal loss. We covered that in the last module. Okay, so what if instead we reverse the roles and we say, look, what if a watch cost $900, but it was only worth $600 at the time of the gift, which is kind of in a way more likely. So in this case, it's depreciated property. As a result, the basis depends on the sale price. Since the sale price is $400 and that's less than the market value at the time of the gift, then the basis equals market value. Okay. So that would also generate in this case, coincidentally, a $200 non-deductible personal loss. Okay, what if we go through the same as the previous one? So it cost $900, but it was worth $600, and then Steven sold it for $700. Since the selling price is in between the market value at the time of the gift and the original basis at the time of the gift, we call that in between. And what you do is you set the amount realized you set the adjusted basis equal to the amount realized of $700, and as a result, no gain or loss would be recognized. Okay, so there is an adjustment for gift tax when gift tax is paid by the donor on appreciation. That can be added to the basis of the donee. So the donee's basis is equal to the donor's basis plus any unrealized appreciation as a proportion of the taxable gift times the gift tax paid. So the donee actually gets a step up in basis. So there are obviously some pragmatic problems associated with dual. Let's go back and think about Stephen, right? Recall that he can't stand to look at the watch. So do you think he really has any sense as to what its adjusted basis originally was? So probably not. He's probably not in a position to call her and be like, hey, what'd you originally pay for that watch? Because I'm selling the thing. So you can see this creates some pragmatic problems. So when you receive gift property, it's important that you determine what is the adjusted basis of that property at the time of the gift. Okay. So another way to receive gifted property is through inheritance. However, the rules for inherited property are different than those if it's just given as an inter vivos gift or a gift during life. So in this case, it simply takes the fair market value of the property on the date of death. Now, the decedent's estate can choose an alternative valuation date of 6 months later, but they can only make that choice if the value has decreased. The value of the estate has decreased in total. They can't do a item by item election. It's either everything or nothing. And there are special rules for community property, which is that the property stepped up to the fair market value for the surviving spouse. And I think the book does an adequate job of explaining why exactly that is the case. Okay, so our last weird item that we're going to deal with is when we have property that we're converting from personal use to business use. So let's say Marjorie owned a home in San Diego in 2007. Her basis in the home was $750,000. In 2008, Marjorie realized her home was now only worth $500,000. And sure enough, this did happen during the financial crisis, where there were a number of homes that lost quite a bit of value. So Marjorie isn't dumb. She's a San Diego State accounting grad, and she knows that her personal losses are not deductible. But she knows that business losses can be deductible. So Marjorie decides she's going to move to an apartment and convert her personal home to a rental home. And then shortly thereafter, she'll sell the rental for $500,000 and generate a $250,000 business loss. Alternatively, she could just depreciate the whole thing and recover its cost that way. But either way, she would start getting these deductions. However, the tax rules prevent this from occurring. Instead, the basis of property converted from personal to business use is the lesser of the basis or the fair market value at the time of the conversion. It can be its fair market value if ultimately it ends up being sold for a gain. Okay. So one last weird thing is when we purchase a number of items of property in a lump sum, in which case the purchase price has to be allocated to each asset based on the fair market value. So for example, if Theo purchases land in a building for $100,000, The fair market value of the land is 25. The fair market value of the building is 75. Then Theo would simply take the fair market value as the basis. So 25 and 75 in each. Okay. So we've talked basically about property, and now we've talked about amount realized and adjusted basis. So let's apply this to a particular set of property. And what we're focused here in on are capital gains and losses. And we know that capital gains are important because now we know that long-term capital gains enjoy preferential rate treatment, right? 0, 15, or 20%. We also know, or we're going to learn, that capital gains are subject to netting rules, right? So we know that net long-term capital losses are non-deductible. That was part of the last module. However, individuals can take an up to $3,000 net capital loss deduction against their ordinary income. So as a result, understanding what is a capital gain and loss is important. So the default rule is that gains and losses are ordinary, right? So you should think of anytime you have a gain or loss, the first thing that should pop in your head is, well, that's an ordinary gain or loss, right? We generally get capital gains and losses only from the sale of capital assets. Now, when we get to chapters 12 and 13, I think mostly 13, we're going to back way off on that assumption and realize that Section 1231, 1245, 1250, unrecaptured 1250, collectibles in Section 291 are all exceptions to that rule. Okay, so if generally they come from the sale of capital assets, then what is a capital asset becomes an important definition. However, the tax code has decided that they are not going to define what is a capital asset. Instead, they're going to define what is not a capital asset. So anything that is not a capital asset by default is a capital asset. And qualification as a capital asset can depend in part on the purpose for which the taxpayer is using those assets or property. So both individual and corporate taxpayers generally prefer capital gains to ordinary income. Individuals for rate purposes and corporations for netting purposes, knowing that net capital losses are not deductible. Okay, so what is not a capital asset? Inventory, trade or business property, which is a giant category of property. Patents, inventions, models, designs, secret formula, copyright, so a handful of intangibles. Accounts or notes receivable acquired in the ordinary course of a trade or business, a publication of the U.S. government, and then a handful of other things that frankly are a little less important. These are all not capital assets. And again, I want to draw your attention. First, inventory, right? No surprise there. But secondly, any trade or business property. So property used in a trade or business is not a capital asset. So let's talk about this different treatment for a second. So let's say Jimmy owns a car for personal use. As it turns out, that is a capital asset, right? Because there's nothing on the not a capital asset list that would sweep that in. Jimmy owns a car dealership that owns a car. Well, car dealerships, a car would be inventory for them. And since we know inventory is not a capital asset, then in this instance, it would not be a capital asset for the car dealership. If Jimmy operates a business in which he uses a delivery car, that is property used in a trade or business, and as a result is not a capital asset. So you can see that its use can affect its classification. So Pop's Moneybags is a real estate developer, and he owns 450 acres of the property surrounding California State Road 56. And he's already built 200 homes, and he has a mind to build 200 more homes. So when Pop sells his property, it feels more like inventory and not like a capital asset. Now, just across the road is Farmer Brown. Farmer Brown is a farmer. And he also owns 450 acres. His property happens to be on California 76. He's getting old. Old Farmer Brown's getting old, and none of his kids want to operate a farm. So he's thinking of selling. So at what point does Farmer Brown, as he sells his property, does he get to treat that as a capital asset? Now remember, it's got to be on the not a capital asset list to not be a capital asset. And there's nothing really that says if a farmer owns property that it's not a capital asset. But at what point could Farmer Brown turn into Pops? If Farmer Brown subdivided his property into 200 lots, wouldn't he suddenly be more like Pop's money bag? And he would have to treat it like inventory. The Internal Revenue Code provides a safe harbor under Code Section 1237 for folks like Farmer Brown. So first off, in order to qualify, the taxpayer must not be a corporation, and generally speaking, an individual. They must have held the property for at least 5 years, unless that property was inherited. There may be no substantial improvements made to the property. And lastly, the property may not have been previously held for sale, aka as inventory. And if you meet all these, any sale receives capital treatment. However, the safe harbor only applies for the first 5 lots sold. On the 6 lots sold, 5% of the gain has to be treated as ordinary, not as capital. However, pragmatically, it generally makes no difference, since you're allowed to deduct the selling costs against the ordinary portion first. And since realtor commissions often exceed 5%, for the most part, the ordinary gain gets wiped out anyway. So remember our character planning variable, and we should recall that deductions are worth more at a higher marginal tax rate, and that we'd rather pay lower marginal tax rates on our income and gains. So if regular or ordinary rates are 35% and our long-term capital gain rate is 15%, what kind of gains would we prefer and what kind of losses would we prefer? Well, if we generate a $10,000 gain, the ordinary taxes at 35% would be $3,500, whereas the capital gains taxes would be a mere $1,500. So with gains, we generally prefer capital gains. With losses, the ordinary tax benefit would be $3,500, whereas the capital loss tax benefit would be at most $3,000 times 35%. That's the maximum net capital loss you can take against your ordinary income, or only $1,050. So generally speaking, we prefer our losses to be ordinary character. This also raises the importance of holding period as part of our tax planning. If we assume ordinary rates are somewhere around 37% and long-term capital gain rates are 15%, short-term capital gain rates are taxed the same as ordinary rates. So you can see that the long-term treatment gets a substantial preference over short-term treatment. Long-term means held for more than 1 year. This generally excludes the date of acquisition but includes the date of sale. And 1 year is based on calendar months, aka 12 months, not 365 days. For sales of stocks and securities, we generally consider the date to be the trade date, not the settlement date. So now let's apply some of the basic netting rules for capital gains and losses for non-corporate taxpayers, so for individuals. Capital gains and losses are required to be netted against each other when the signs are opposite. So assume from this point forward that netting means the signs are opposite, because summing would be when the signs are the same. So first you would bucket everything into the short term and bucket everything into the long term, and net all short-term gains and losses against all other short-term gains and losses, and then the same thing with long-term. And then you can end up with having both be gains, both be losses, a net gain short-term or long-term, or a net loss short-term or long-term. If both are gains, then the short-term is taxed as ordinary, and the long-term gains are taxed at preferential rates. If both are losses, then you use the short-term first as your $3,000 offset to your ordinary income, and then long-term to the extent you have more to get to $3,000. The carryover keeps its character for individuals. So if you have short-term carry forward, you continue to treat it as short-term. If you have long-term, you continue to treat it as long-term. If you end up with a net short-term gain, you treat that as ordinary. If you end up with a net long-term gain, you apply preferential rates. If you end up with a net short-term or long-term loss, then you use the $3,000 and carry forward whatever is left. Corporate taxpayers enjoy a different type of netting, and of course do not get that $3,000 that they can apply against their ordinary income. So if you're a corporate taxpayer, first you would net short-term and long-term just as before. Net gains are not taxed at preferential rates. So the differentiation between short-term and long-term becomes considerably different. And net losses are not deductible. Instead, they could be carried back 3 years or then forward 5, or you can make an election to simply carry them. So individuals have a more complex netting. I'm going to explain the rules behind the complex netting, but we're not going to do any examples in the video. Instead, we'll do them in class. And then once we've done a few cycles, then I'll post a video after the fact, because to do one now, we'll just all get lost. So step one is to net your 1231 gains and losses. Now, the reality is most of you probably don't know what 1231 gains and losses are. So at least at this point, we can kind of ignore this rule and move on to step two. But when we get to chapters 12 and 13, we'll come back around to this. So step two is to group each gain into its rate bucket. Now, I know up to now we've been talking about there being short-term and long-term only, but as it turns out, there's more than just that. So there's, of course, a short-term capital bucket. There's what we would call our typical long-term gain, capital gain bucket. That's the ones that could be taxed at 0, 15, or 20%. We're going to learn later on in the course that there's also something called unrecaptured Section 1250 gains. Those are actually taxed at 25%. And then to the extent you sell collectibles at a gain or loss, those are taxed at 28%. So you classify each gain into its rate bucket, and then you net each bucket. So again, all the short term against all the short term, all the 0, 15, 20s against all the other 0, 15, 20s, all the 25s, and then all the 28s. So you end up with 4 net numbers. In the next step, you take your result from the 25 and the 28 categories, and you net them together if they are of the opposite sign. If they're of the same sign, you don't do anything. When you net them, the larger absolute value always swallows the smaller absolute value. You take the result of step 4 and net that against 0, 15, 20 if of the opposite sign, putting anything from 0, 15, and 20 into the highest percent rate bucket first. But again, larger absolute value swallowing smaller absolute value. Next, you would offset short term against the results of step 5. So against the 0, 15, 20, against the 25 or the 28, again, choosing the highest rate first. Okay, there's really no way to do this in the video. We'll do some of these in classes, but you may want to have that slide handy when we do it. Another bizarre capital gain treatment is for worthless securities. So this is if you have stocks or bonds that you've invested in and they've become totally worthless. So what happens is you treat it as if they were sold on the last day of the year. You don't really need to worry about the 80% substance. That's a corporate rule, and we're focused on individuals. Okay, the next section deals with bonds. And if you've never had your BA 323 class, you're probably going to struggle a little bit in this section. And the reality is this is a tax course, so I'm not going to spend too much time beating you up on the quizzes and exams on these bond-related items, but you should get some exposure to them. I believe I do have one homework problem associated with it, and you should have an understanding if you decide to dive deeper into this issue. Having some basic understanding at this point makes sense. Okay, so let's start with something known as original issue discount. And this occurs when a bond is issued, so originally issued at a price less than the face value of the bond. So for example, if you had a $10,000 bond and it was paying 3%, well, it could be that the market says, well, that bond should pay 4%. So rather than loaning you $10,000 to receive back $10,000 plus interest, the investor says, well, look, I'm only going to loan you $9,500 for you to pay me back $10,000 plus interest. And that additional $500, that's original issue discount, which really just represents additional interest. So the rules require to amortize original issue discount using the effective interest method. And as you do so, you adjust the investor's basis or the taxpayer's basis in the bond. We can contrast that with market discount. Market discount occurs when an investor buys a bond on the secondary market. So it's already been issued, someone else has bought it, and now someone else is buying it. There's been a shift in interest rates. And so suddenly the interest rate that this particular bond is paying has fallen out of favor. And so as a result, the next buyer doesn't want to pay as much as the previous buyer did, or certainly its face value. So you're required to accrete your market discount into your basis, either using a daily average, which just means like amortize it over the number of days, or the effective interest method, which is more of a compounded interest method, and reflect that at the sale. Or you can actually accrete the market discount in every day and reflect it in your annual income and adjust basis at the same time. So if you think the second section allows you to accrete all the discount in on the date you sell the bond, the second method forces you to go ahead and accrete the income in annually. Market premium is the opposite of discount. This is when the price of the bond has gone up with respect to the face value, and you're required to amortize premium as interest expense, or you can just leave it in the basis until the sale, so the same as discount, unless that is a municipal bond, in which case market premium must be amortized. Okay, let's do an example. This is on 1112. Ollie purchased a newly issued $1 million face value bond, 30 years, paying 4% interest semi-annually for $300,000. So already we know, look, they're loaning the company $300,000 to receive $1 million back in 30 years. This clearly is original issue discount. The bond's actual annual yield is 14%. And again, interest is paid semi-annually on the 1st and then July 1st. So how would we calculate Ollie's income from this bond for the first 2 years of its life? So again, this is newly issued, so the discount is OID. And OID must be amortized using the effective interest method. You do not get to use the number of days method. So we'd start with the carrying value of $300,000 on the first day. Must be that $300,000 at 14% for half a year is $21,000. So the $21,000 of that, Ollie receives a $20,000 interest payment on the bond. The remaining $1,000 is amortized discount. He would include that in his basis, his carrying value of the bond, and also reflect that as interest income. At the next payment on the following year, his carrying value is up to $301,000 because of the previously amortized discount. So now the 14% would yield $21,070. Again, he receives a $20,000 payment, so the additional $1,070 represents amortized discount. And you can walk your way through this for the next 30 years until ultimately all $700,000 of that discount would be amortized if Ollie managed to hold the bond until maturity. Okay. So John Oliver, on the other hand, purchases a $10,000 7% bond for $63.50 on 1/1/28. The bond was issued at par on 1/1/2017 and matures 5 years later at 1/1/2022. And in a year after buying it, John sells the bond for $8,000. And let's assume that John does not accrete his market discount currently. What is his income from the sale? So in this particular instance, the bond was issued at par, so it was issued at $10,000. But here we are a year later, interest rates must have moved, and John can pay only $63.50 for it. So as a result, there's market discount. So you can use the daily basis method or the effective interest method. If we assume the daily basis method, which is the easier of the two, the amount realized on his sale is $8,000. His basis is $63.50. Therefore, his realized gain would be $16.50 and probably his recognized gain as well. So now what we have to do is determine the character. Well, remember, we have to accrete in that market discount now. So we would take the amount of discount amortized over the period. So recall, his market discount is the $10,000 face value minus the $63.50. It had a 4-year life at the time he bought it, and he held it for 1 year. So that yields $913 of ordinary income due to discount amortization. The remaining balance of the gain, so the 1650 minus the 913 or 737, is treated as capital gain. And I've provided another example that shows the effective interest method for anyone who'd like to apply that. All right, another potential investment that taxpayers can get involved in are stock options. So we're only going to deal with call options. We're not going to deal with put options. So a purchased call option is the option to buy a stock at some fixed price at some point in the future. And if it's exercised, then what happens is you would include the option price in the basis of the stock that you purchase. So if you pay $2 to buy stock at $30 and then later you exercise that option, in fact purchase the stock for $30, your basis would be $32, which is the price of the stock plus the price of the option. If, on the other hand, that option is allowed to expire or you sell it, then you simply treat it as a sale. If it expires, you treat it as a sale where the amount realized is zero. A written call option is the option to sell. So if that's exercised, it simply becomes part of the sales price. So think of it as additional proceeds or additional amount realized. And again, if it's expired or sold, it's treated as a short-term capital gain, typically with zero amount realized. With zero adjusted basis. Okay, so one last thing before we're done is that the Tax Cuts and Jobs Act made a subtle but important change to the definition of what is not a capital asset under 1221. So formerly the tax law listed copyrights, literary, musical, or artistic compositions, if they were created by the taxpayer, as not capital assets. That not capital asset list was expanded in late 2017 and now includes a patent, invention, model, or design, whether or not patent, a secret formula, or process if created by the taxpayer. Okay, we can certainly deal with there being some additional intangibles now included as part of not capital assets. The problem is in section 1235, the code takes a conflicting position, which is that when a taxpayer sells a patent and that taxpayer is the individual that created the patent, then it's to be treated as a long-term capital gain to the extent it generates a gain. So one of the problems is I have one code section that says, hey, don't treat that as a capital asset, and then another one that says, but if it's sold, treat it as a long-term capital gain. So in addition, there's a new section that carves musical compositions and copyrights in musical compositions that are held by the creator out of the capital gain exception treatment. So again, those also would be treated as capital if they were sold. So we have some conflict between 1221 and 1235 that has not been addressed, and the IRS has said, at least for now, 1235 rules. That brings us to the end of Chapter 5. I'll see you guys in class.